12 mind-blowing things a private investor learned after day trading $35 million over 25 years. 3 months ago, the Sweetie Kiwi production team met with a private investor who has day traded over 25 years, overseeing $35 million in personal and family money. Requesting anonymity as a prerequisite to the interview, this 47-year-old Iowan walked us through his daily routine and then gave us the best stock market advice ever. And it isn't what you think. The 12 mind-blowing lessons reported in this show are a summarized version of the 7-hour conversation we had with this experienced financier. Stay tuned and enjoy the wisdom. Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy to be your host today. I hope you are doing fantastic. If you are doing marvelous as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today we're going to talk about 12 mind-blowing things a private investor learned after day trading $35 million over 25 years. I want to quickly acknowledge some of our fans over the world, specifically in Kansas. So we have Rose Sutton in Lawrence, Kansas, Corey Williams in Leawood, Kansas, and Elliot Morris in Olafi, Kansas. Really appreciate it. The number one thing that this private investor learned is if you fail to plan, you plan to fail. In other words, folks, if you don't plan, you are planning to fail. So you want to assess your current situation, define your goals, determine your risk tolerance, decide what to invest in, and most importantly, monitor your investments. This should be the cornerstone. This should be the cornerstone of a real investment plan. That's the number one lesson. Number two lesson, you cannot predict the future, right? Everybody thinks they can do so, but they can't. Now, the thing here is that the thing experienced investors understand is that even economists cannot predict the future. They cannot predict corrections, recessions, and the stock market is far from rational, right? If you invest too much, if you have too frequent trades, if you trade every day, you'll get bleeded on commissions and taxes, right? So it's very hard to be right twice. If you have a good day, just take your cash and go back home, right? Now, one thing that's very important, and the one thing we learned from talking to this sophisticated investor is that if you sit out the markets, this will rob you of income yield. In other words, just because you are thinking that the market is not going in your direction at the moment and you just sit it out, you are actually losing on opportunities. So it's always important to have the solid plan, get in the market, and just stay put, be patient. Number 3, never put your eggs in one basket, no matter how sturdy that basket is. Let me repeat that. This is kind of important here. Never put your eggs in one basket, no matter how sturdy it is. This harks back to diversification, right? And diversification is very important because it reduces volatility. Something happens in the stock market if you are properly diversified. In other words, if you have your eggs in several baskets, in the bond basket, in the ETF basket, in the alternative investment basket, you are reducing volatility if there is correction or some kind of movement in one specific market, right? Diversification exposes you to more opportunities for return. It also minimizes the risk of loss to your overall portfolio, right? And more importantly, for those who remember a few years ago, the 2008 credit crisis, if you were properly diversified back then, chances are that diversification would have safeguarded you against the adverse market cycle. Okay, so those are the first 3 things that we learned from this private investor. Number 1, if you plan to fail, if you fail to plan, you plan to fail. Number 2, you cannot predict the future. Don't even try. Number 3, never put your eggs in one basket, no matter how sturdy, no matter how solid you think it is. I'll be right back right after this. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation about the 12 mind-blowing things a private investor learned after day trading $35 million over 25 years. Quickly give a shout out to Ellie Houghton in Springfield, Massachusetts, Jess Williams in Lowell, Massachusetts, and Harry Austin in Cambridge, Massachusetts. Thank you so much. Thank you. Thank you to our millions of viewers and listeners all over the world. Number 4. It doesn't matter if a trade is good or bad. This is very important. It doesn't matter if a trade or trading day, for that matter, is good or bad. Because as an investor, you're going to have good and bad days, right? But the thing is that it's not about the individual days. It's about the long term. So you have to get in a situation where you assess your performance over a month, over a quarter, over 6 months, over a year, as opposed to zeroing on the individual days, right? Because you're going to have ups and downs. The market has it, you're going to have it too. So it doesn't matter if a trade is good or bad. What matters is the long-term or medium-term performance. Number 5, don't ever get emotional, right? So investing based on emotion, and here I'm talking about fear, greed, anxiety, and so on and so forth, is the main reason why so many people are buying at market tops and selling at market bottoms, right? Because there is no sort of a solid planning around that. The trades, everything is driven by emotion. So don't get emotional here. If you can stay the course through short-term volatility, you are sure to get long-term success as an investor. At least that's what we learned after talking to this guy, to this 47 Iowa residents here, right? So focus on diversification, have a plan, and stay the course. Number 6, remember that you are trading against heartless machines. Now, don't even get me started about emotional artificial intelligence nowadays and robot trades, but you have something called stock market robots, and this is not the phenomenon of having robots executing trades is not limited to stock markets. You are talking about the whole financial system. So many markets use those robots, right? Now, stock market robots have finally taken over, right? You have things like computerized systematic trading tools, aka trading robots, or simply trading bots. They are extensively used by quantitative funds. I'm talking, quant funds. I'm talking hedge funds, alternative investment funds, that kind of stuff, right? Now, quant funds are pretty prominent in the market nowadays. In other words, you have machines making the investment decisions. So in that context, it is very important not to be emotional. It's very important to have a plan because, opposite you have a machine, and we all know machines don't have emotions, at least not yet. So try to think about this thing this way and focus on your plan and stay the course. All right. So quick recap here. Number 4, it doesn't matter if a trade or a trading day is good or bad. Number 5, don't ever get emotional. Number 6, you are trading against heartless machines. I'll be right back right after this. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having our conversation here. Please subscribe to our channel if you like the content, the clarity, and the quality of the content we've been producing so far. We drop this kind of shows once or twice a day, or sometimes even more. Really appreciate your support and your feedback. Please turn on the notification bell so you are made aware of new shows. Like this content, share it. We want to have multiple multimillionaires in America and the whole world. Share it. Comment below, give us your experience when it comes to day trading or investment in general. We'll really appreciate it. Want to quickly give a shout out to KAYLEIGH Collins in Colorado Springs. She is in Colorado. Ray Newman, who is in Denver, Colorado, of course, and Nicholas Jackson in Fort Collins in Colorado. Really appreciate it. Nicholas, Ray, and KAYLEIGH, thank you so much all the way from Colorado. Number 7, the mind-blowing lesson we learned after talking to a private investor is that the market has emotions and a soul. That's kind of crazy, but yes. See, earlier I was talking to you about not having emotions when trading, but the market as a whole, in other words, the aggregation of thousands, if not millions of investors and machines and emotions, all these things, all this aggregate has emotions and a soul. You probably heard of concepts such as investor irrationality, the power of the story, people having overconfidence. You have herd behavior. Now, herd behavior is very interesting because herd behavior is the tendency of people to be swayed by crowds, right? So, and you see this a lot in the financial sector, especially financial markets. When people start selling, you have a panic sale. People start selling, and everybody starts selling without knowing exactly why the investor next door is selling. So that's herd behavior. All those things, again, gives as a whole a soul to the market. Number 8, remember that hope is never a strategy. Because if you get to the point where you hope you don't get ruined or that your portfolio will be balanced or you will make a profit, then you did something wrong beforehand. Remember what I told you earlier. You need to have a plan, and you have to stick to your plan no matter what. Of course, you can review your plans periodically, every 6 months, every year, but don't get swayed into the everyday yo-yo effects of the market, right? So hoping in itself is not a bad thing, right? But the hoping shouldn't be the only thing you rely on. The hoping should be part of your arsenal of tools that you're using, right? But the most important thing should be planning. Again, a machine, a trading robot doesn't hope. It executes a plan. It executes a program. It executes a code, right? My point is you don't have to be a robot here, but you need to basically you have to allocate more time to planning as opposed to hoping, all right? Number 9, the number 9 mind-blowing thing we learned from a private investor who has day traded $35 million over 25 years is you want to focus on your health first and foremost. Remember that day trading will pull everything out of you, right? It will suck the soul out of your body. It will make you miserable. It will make you anxious. So you got to take care of yourself. You got to eat well. You got to exercise. You got to surround yourself with positive people. You got to sleep enough. Blah, blah, blah. You have to do all this stuff because the market has a soul and you're trading against machines. So you got to take care of yourself. The bottom line here is that in terms of the lessons we learned after talking to this investor is that this is a marathon. This is not a sprint. This is not a 100 meter sprint. This is a marathon. This is a 26.2K, right? This is a 42.1K. All right. So basically this is what you want to think about here. So want to recap here. Number 7, remember the market has emotions and a soul. Number 8, hope is never a strategy. Number 9, focus on your health first and foremost. I'll be right back right after this. I'm going on. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation here. Just gonna quickly give you a context of today's conversation. If you just joined us and you are kind of ask yourself, what are we talking about? We're talking about 12 mind-blowing things a private investor learned after day trading $35 million over 25 years. I want to go to number 10. Number 10, forget the hype, stick with the fundamentals, and go sleep. Now, before I do that, let me give a shout out to our beautiful listeners and viewers from Hawaii. We have Rose Hawkins in Kapalua, Hawaii, of course. We have Lane Richardson in Waiakoa, Hawaii, and Rory Webb And why look who are. So Lori, Lane, and Rose, really appreciate your support and contribution and help and feedback. Thank you so much. Number 10, forget the hype. Stick with the fundamentals, right? This goes back to what I said earlier. You want to have a plan where you know when to get in the market and when to exit. Forget the hype. What is the fundamental analysis here? Fundamental analysis is the process whereby you assess a security's intrinsic value by evaluating all aspects of a business or market, right? I'm talking about things like tangible assets. You want to look at the company's tangible assets, land, equipment, buildings, right? And you review things that are intangible, such as trademarks, patent, branding, or intellectual property, right? And you also want to review the company's financial statements, historical data, press releases, analyst reports, analyst estimates, investor conference calls. The reason why this is important is that sometimes the market is irrational, and the market might actually sink a good company's stock. So the company is losing market share. The company's share is sinking, even though the company's fundamentals are sound. So if you get drawn into this sort of irrational exuberance, this irrational behavior, you might be tempted to sell the share of an otherwise good company. So you want to forget the hype, stick with the fundamentals, and go to sleep. Now, when you do that, you are in effect adopting the routine of a category of investors called value investors, right? And value investors, the most prominent of whom is Warren Buffett, right? So he sticks to the fundamentals, knows the companies he invests, knows pretty well the companies in which he invests his money, and that's all you need. Number 11, don't bet more than 5% on a single position, no matter how appealing. This is very important to set limits. And this sort of harks back to the diversification, right? Remember what I said earlier, don't put all your eggs in the same basket, no matter how sturdy you think it is. Similar approach here. Don't bet more than 5% on 5%, of course, of your cash on a single position, no matter how appealing. Things happen. The market goes up and down. You might think this position is just wonderful, it's sturdy, it's going to produce a lot of income. You never know. You never know. So this is something that we learned after speaking to this private investor, and this is someone who has 25 years experience and has traded $35 million or more of his money and family money. Okay. And number 12, the 12th mind-blowing thing we've learned from this guy is that uncertainty is your best friend. Why? Because the thing here is that you're trying to predict the market, but sometimes not only you cannot predict the market, but uncertainty can actually go your way. What I'm trying to say here is that even though you cannot predict what will happen in 1 year or 2 years or 6 months, or even though you can't do that, you always have to hope for the best. You always have to, after planning carefully, you have to think of yourself that the market will reward you. And this is where uncertainty comes, right? Because the ups and downs of the market will lead ultimately to a great return for you if you're able to stick it out, if you're able to stay put, if you're able to stay in the market for a long time. So don't try again to predict the market. Don't try to have everything under control. In other words, you want to reduce the uncertainty. You can't anyway. You cannot do this anyway. All right. So this is basically it. So number 10, forget the hype. Number 11, don't bet more than 5% on a single position. And number 12, remember that uncertainty is your best friend. I'll be right back right after this. Go in. Welcome back, folks, to another edition of Sweetie Kiwi. We are about to wrap up today's conversation. I want to quickly give a shout out to Julia Hopkins in Tallahassee, Delaware, Chris Aguirre in Rising Sun, Delaware, beautiful name, Rising Sun, Alvin Cook in Fenwick, Island, Delaware. I want to quickly invite our many millions of viewers and listeners to continue supporting us, to continue giving us their feedback. Please subscribe to our channel if you like the quality and clarity of the content, and turn on the notification bell so you are notified, of course, when we drop a new jam such as this one. Like this content, share it with other viewers and listeners who might be interested, or other family members or colleagues. Comment below, give us your experience about day trading, or investments in general. And today's conversation started because there is a context, all right? And the context was that 3 months ago, the Sweetie Kiwi production team met with a private investor who has day traded over 25 years, overseeing $35 million in personal and family money. Requesting anonymity as a prerequisite to the interview, this 47-year-old Iowan walked us through his daily routine and then gave us the best stock market advice ever. And it isn't what you think. So here are the 12 mind-blowing lessons reported in this show. Quickly give you a recap here. So 1, if you fail to plan, you plan to fail. Number 2, you can't predict the future. Number 3, never put your eggs in one basket no matter how strong you think it is. Number 4, it doesn't matter if a trade or trading day is good or bad. Number 5, don't ever get emotional. Number 6, you are trading against heartless machines. Number 7, the market has emotions and a soul. Number 8, hope is not a strategy. Number 9, focus on your health first and foremost. Number 10, forget the hype and stick with the fundamentals. Number 11, don't bet more than 5% on your single position, no matter how appealing. Number 12, uncertainty is your best friend. Now, here is today's call to action. As you all know, in every show we like to have a call to action. We want to provide information to the listener, but we also want to invite people to take action and improve their lives and make decisions, that kind of stuff. Today's call to action is very simple. Here is it. Set investment goals. Invest early. Make investments automatic. Look periodically at your finances. Learn about investing. Set up retirement accounts. Remember to be wary of commissions. Diversify your investments. Study your portfolio. And keep informed. All right? This is it, folks, for today's show. Oh, yeah. Well, I'll be right back for today's pro tip. Don't go anywhere. Here is today's pro tip. Whether you are an experienced investor or just starting out, remember that your first priority should always be to build up an emergency fund. Once that's done, consider investing. It's important to form saving and investing habits by setting aside money on a regular basis. Remember, your assets will build over time, and you will gain momentum and feel encouraged as you watch your balances grow. Thank you, and be marvelous.